Hello, everyone, and welcome. In this lecture, we will learn how financial statements tell the story of a business. Many students first see financial statements as accounting reports filled with numbers, categories, and formulas. But I want you to think of them differently. Financial statements are a structured language for understanding a business. They tell us what the firm owns, what it owes, how it is financed, whether it is profitable, whether it is generating cash, and whether it is investing for the future. When managers, investors, lenders, analysts, employees, and suppliers look at financial statements, they are not just reading numbers. They are asking practical questions. Does the firm have enough resources? Can it pay its obligations? Is it earning a profit? Is it turning sales into cash? Is it growing wisely or taking too much risk? In this lecture, we will focus on the three major financial statements: the balance sheet, the income statement, and the statement of cash flows. Most importantly, we will learn why these statements should be read together. A single statement gives one view. Together, they give the business story. Let's begin with the three major financial statements and the main question each one answers. The balance sheet answers this question: what does the firm own? What does it owe? And how is it financed at a specific point in time? It shows assets, liabilities, and owner's equity. The income statement answers a different question. Was the firm profitable during a period of time? It shows revenues, expenses, gains, losses, and net income. The statement of cash flows asks, how did cash move into and out of the firm during a period of time? It separates cash flows into operating, investing, and financing activities. A helpful way to remember the difference is this. The balance sheet is like a financial snapshot. It shows the firm's position on one date, such as December 31st. The income statement and statement of cash flows are like financial movies. They show activity over time, such as a month, a quarter, or a year. This timing difference is very important. A balance sheet dated December 31st shows where the firm stands on that date. An income statement for the year ended December 31st shows what happened during the entire year. Now, let's look more closely at the balance sheet. The balance sheet reports the firm's financial position at a specific point in time. It shows the resources controlled by the firm, the obligations owed by the firm, and the owner's claim on what remains. The basic balance sheet equation is assets equal to liabilities plus owner's equity. This equation must always balance. Why? Because every asset has to be financed in some way. If a firm has cash, inventory, buildings, equipment, or software, those assets came from somewhere. They may have been financed by borrowing from creditors. They may have been financed by contributions from owners. They may also have been financed by profits that were kept in the business. The balance sheet helps us understand financial structure. It tells us how much cash the firm has, how much money is tied up in receivables and inventory, how much has been invested in long-term assets, and how much the firm owes to suppliers, lenders, and other creditors. However, the balance sheet does not directly tell us whether the firm was profitable during the period. It also does not directly tell us whether the firm generated cash during the period. For that, we need the income statement and the statement of cash flows. Let's focus on the asset side of the balance sheet. Assets are resources controlled by the firm that are expected to provide future economic benefits. In simple language, assets are what the firm uses to operate, sell, produce, invest, and grow. Assets are usually grouped into current assets and long-term assets. Current assets are expected to be converted into cash, sold, or used within 1 year or one operating cycle, whichever is longer. Common current assets include cash and cash equivalents, accounts receivable, inventory, and prepaid expenses. Accounts receivable represents amounts customers owe the firm. Inventory represents goods held for sale or materials used in production. Prepaid expenses represent payments made in advance for benefits the firm will receive later. Long-term assets are expected to provide benefits beyond 1 year. These may include property, plant, equipment, buildings, machinery, long-term investments, and intangible assets, such as patents, trademarks, software, or goodwill. The asset side of the balance sheet tells us where the firm's capital is invested. A retailer may have large inventory. A manufacturer may have major equipment. A software firm may have fewer physical assets, but important intangible value. So, assets also tell us something about the firm's business model. Now, let's move to liabilities and owner's equity, the right side of the balance sheet. Liabilities are obligations the firm owes to outside parties. They represent claims by creditors. Like assets, liabilities are usually divided into current liabilities and long-term liabilities. Current liabilities are obligations expected to be paid within 1 year or one operating cycle. These may include accounts payable, wages payable, taxes payable, short-term notes payable, and the current portion of long-term debt. Long-term liabilities are obligations due beyond 1 year. These may include long-term bank loans, bonds payable, lease obligations, and deferred tax liabilities. Owner's equity represents the owner's residual claim on the firm after liabilities are satisfied. For a corporation, equity commonly includes contributed capital and retained earnings. Retained earnings are profits kept in the firm rather than distributed to owners. A useful way to interpret the right side of the balance sheet is to ask, who has claims on the firm's assets? Creditors have contractual claims through liabilities. Owners have residual claims through equity. The balance between liabilities and equity matters because it affects risk. Debt can help finance growth, but it creates fixed obligations. Equity is generally more flexible, but it may dilute ownership or be costly in other ways. Next, let's study the income statement. The income statement reports revenues, expenses, gains, losses, and profit over a period of time. Its central question is, did the firm generate accounting profit during the period? A simple version of the income statement is net income equals revenues minus expenses. More detailed income statements usually move through several levels of profitability. They begin with sales or revenue. Then they subtract cost of goods sold to arrive at gross profit. After that, they subtract operating expenses to calculate operating income. Then interest expense and taxes are considered, leading finally to net income. The income statement is especially useful for understanding profitability, margins, and operating performance. It shows whether the firm is selling goods or services for more than the cost of producing, delivering, and supporting them. But revenue growth alone is not enough. A firm can sell more and still become less profitable if expenses rise faster than revenues. That is why analysts look at gross margin, operating margin, interest burden, tax impact, and net margin. The income statement helps us see whether the business model is producing accounting earnings. It tells us whether the firm is not only active, but also profitable. Now let's separate three ideas that students sometimes mix together: revenue, expense, and cash. Revenue is the amount earned from selling goods or services, but revenue is not always the same as cash collected. Under accrual accounting, revenue may be recognized when it is earned, even if the customer has not yet paid cash. Expenses are costs incurred to generate revenue, but expenses are not always the same as cash paid during the period. A good example is depreciation. Depreciation is an expense that spreads the cost of a long-term asset over time. It reduces accounting profit, but it does not require a cash payment in the period when it is recorded. Profit is the difference between revenues and expenses. Profit matters because it shows whether the firm is creating accounting earnings from its activities. But profit should not be confused with cash flow. This distinction is extremely important in finance. A business can report sales and profit while still waiting to collect cash from customers. A business can also record expenses that do not immediately use cash. That is why the income statement gives one important part of the story, but not the whole story. To understand cash movement, we need the statement of cash flows. The statement of cash flows explains how the firm's cash balance changed during a period. A simple way to summarize it is change in cash equals to operating cash flow plus investing cash flow plus financing cash flow. The statement of cash flows is powerful because it answers questions the income statement cannot answer by itself. Did the firm collect cash from customers? Did it pay cash to suppliers, employees, lenders, and tax authorities? Did it invest in long-term assets? Did it borrow money, repay debt, issue equity, pay dividends, or repurchase shares? Operating cash flows arise from the firm's core business activities. They include cash collected from customers and cash paid for operating costs. Operating cash flow is especially important because it shows whether the core business is generating cash. Investing cash flows arise from buying or selling long-term assets and investments. Cash paid for equipment, buildings, vehicles, software, or acquisitions appears here. Negative investing cash flow is not automatically bad. It may mean the firm is investing for future growth. Financing cash flows arise from transactions with lenders and owners. Borrowing money, repaying loans, issuing stock, paying dividends, and repurchasing shares all belong here. Cash matters because a firm needs cash to survive, pay bills, repay lenders, invest, and handle unexpected shocks. Now let's connect the three statements. The financial statements are not separate stories. They are linked views of the same business. First, net income links the income statement and balance sheet. When a firm earns net income and keeps it in the business, retained earnings increase. When the firm pays dividends, retained earnings decrease. So we can think of ending retained earnings as beginning retained earnings plus net income minus dividends. Second, cash links the balance sheet and statement of cash flows. The ending cash balance on the statement of cash flows should match the cash balance on the balance sheet. Third, working capital accounts connect operations to cash flow. Sales made on credit increase accounts receivable. Purchases not yet paid increase accounts payable. Inventory purchases use cash or create obligations. These accounts help explain why net income and cash flow may differ. Fourth, long-term assets connect investment decisions to multiple statements. When equipment is purchased, the asset appears on the balance sheet. Over time, depreciation appears on the income statement. The cash paid appears in investing cash flow. Finally, debt links financing decisions across statements. Borrowing increases cash and liabilities. Interest expense affects the income statement. Borrowing and principal repayment appear in financing cash flow. This is where the business story becomes visible. Let's finish by thinking about how different users read financial statements. Managers use them to evaluate performance and decide what should change. Investors use them to think about growth, profitability, risk, cash flow, return, and value. Lenders focus on liquidity, leverage, operating cash flow, collateral, and debt service capacity. Analysts study trends, margins, ratios, industry comparisons, and forecasts. Employees may care about stability and future prospects. Suppliers may care about whether the firm can pay its bills and remain a reliable customer. A thoughtful reader moves from description to diagnosis. Description asks, what are the numbers? Diagnosis asks, what do the numbers mean? Is revenue increasing or decreasing? Are expenses growing faster than revenue? Is the firm profitable at the gross, operating, and net income levels? Is operating cash flow positive and recurring? Are receivables or inventory growing unusually fast? Is the firm investing in long-term assets? Is growth funded internally or through debt and equity financing? Is the firm liquid enough? Is it highly leveraged? Common mistakes include treating net income as cash flow, ignoring margins, assuming all negative investing cash flow is bad, assuming all financing inflow is good, ignoring debt, and looking at only 1 year. Financial statements do not eliminate judgment. They make judgment more disciplined. Thank you for joining me. I look forward to seeing you in the next video.